For centuries, the glittering towers of Wall Street have attracted millions of dreamers, speculators, and intellectuals, all searching for the ultimate financial holy grail, a predictable formula to beat the stock market and accumulate vast riches. In his timeless investment masterpiece, Burton Malkiel strips away the complex jargon of professional money managers to examine the core philosophies that drive all investment decisions. Malkiel explains that throughout history, the academic and professional worlds have been deeply divided into two opposing ideological camps, each claiming to understand the true nature of asset pricing. He calls these two schools of thought the firm foundation theory and the castle in the air theory. To understand the chaotic movements of modern financial markets, an investor must first understand the psychological and analytical battles between these two distinct investment castles. The firm foundation theory represents the conservative, logical bedrock of traditional investing, arguing that every single financial asset possesses an intrinsic, measurable value. This intrinsic value can be determined by carefully analyzing a company's current earnings, its future growth prospects, its dividend payouts, and its underlying assets. According to this theory, when the market price of a stock falls below its calculated firm foundation, it represents a clear buying opportunity because the price must eventually rise back to its true worth. Conversely, when the market price rises too far above this foundation, it is time to sell. This approach assumes that human beings are rational actors, and that the market behaves like a giant, cold, calculating machine that always corrects its mistakes over the long run. On the completely opposite end of the spectrum sits the castle in the air theory, a philosophy heavily popularized by the legendary economist John Maynard Keynes. This theory completely discards the concept of intrinsic value, arguing instead that an investment is worth exactly what someone else is willing to pay for it. The castle in the air investor does not care about boring balance sheets, profit margins, or corporate governance. Instead, they focus entirely on mass psychology, trying to anticipate where the crowd of speculators will run next. The goal is not to find a good company, but to find an asset that is currently capturing the public imagination so you can buy it early and sell it to a greater fool at a higher price later on. It is a game of psychological anticipation, where building beautiful castles in the air matters far more than digging for a firm foundation. When the castle in the air mentality completely overpowers the firm foundation theory, the financial world witnesses the birth of massive, devastating economic bubbles. Malkiel takes us on a historical journey to prove that human beings, when gathered in large crowds, are deeply irrational and prone to bouts of financial insanity. He points to the famous Dutch tulip mania of the 17th century, where a single rare tulip bulb was traded for the price of a luxurious estate before the market collapsed to zero in a matter of days. He describes the South Sea bubble in England, which drove ordinary citizens and brilliant scientists alike into a speculative frenzy over a company that had no real business operations. These historical delusions are not ancient history. They repeat themselves in every single generation because human psychology never changes. Malkiel traces this exact same madness through the Roaring Twenties, the conglomerate boom of the 1960s, and the historic dot-com crash of the late 1990s, where companies with zero revenue were valued at billions of dollars simply because they added a .com suffix to their names. He even bridges the gap to modern times, showing how the rise of speculative internet meme stocks and highly volatile cryptocurrency crazes are driven by the exact same castle in the air psychology that fueled the tulip mania 400 years ago. When the music stops and the crowd panics, the illusory castles always come crashing down, brutally reminding investors that a stock cannot outrun its firm foundation forever. Wall Street has created an entire industry of highly paid professionals who claim they possess the precise analytical tools required to predict where the stock market is headed next. These professionals are broadly divided into technical analysts, often called chartists, and fundamental analysts. Burton Malkiel enters this arena with a sharp, skeptical lens, dismantling the claims of both groups and revealing that their expensive strategies are largely built on grand illusions. He argues that the financial industry sells the illusion of predictability to justify its massive fees, while the actual tools used by these professionals are no more effective than reading tea leaves or consulting an astrologer. Technical analysis is the art of looking at historical stock price charts and trading volumes to predict future price movements. Chartists believe that history repeats itself and that human psychology leaves distinct, recognizable patterns on stock charts. They spend their days searching for mystical formations like head and shoulders, double bottoms, and resistance lines, believing that if a stock breaks through a certain visual barrier, it is guaranteed to rise or fall. Malkiel completely eviscerates this approach by presenting extensive academic research proving that past price movements have absolutely no predictive power over future price movements. Chartists see head and shoulders pattern, illusion of control to prove this. Researchers have generated charts using random coin flips, and professional technical analysts were unable to tell the difference between a real stock chart and a chart generated by pure, unadulterated randomness. The human brain is naturally hardwired to find patterns in chaotic noise, and that is exactly what chartists are doing. They are looking at a series of random data points and inventing a narrative to explain it. Malkiel bluntly states that technical analysis is a beautifully designed trap that causes investors to trade too frequently, incurring massive brokerage commissions and taxes while failing to beat a simple buy and hold strategy. Fundamental analysis appears far more respectable on the surface, as it aligns directly with the firm foundation theory. Fundamental analysts study corporate earnings, industry trends, and macroeconomic data to calculate the true value of a company. Yet, Malkiel demonstrates that this method is also plagued by severe structural flaws. The main problem is that fundamental analysis relies entirely on predicting the future, and the future is inherently unpredictable. Analysts must estimate corporate growth rates 5 or 10 years into the world ahead, but their track records prove they are incredibly bad at doing so. A sudden technological disruption, a regulatory change, a management scandal, or a global pandemic can instantly invalidate the most sophisticated spreadsheet model ever created. Furthermore, Malkiel reveals that professional analysts face severe conflicts of interest that cloud their judgment. Wall Street firms make their money by underwriting investment banking deals and keeping corporate clients happy, which means analysts are highly incentivized to issue glowing, optimistic buy recommendations even when a company is struggling. The data shows that professional stock analysts miss major corporate turnarounds and catastrophic bankruptcies with embarrassing regularity. By the time a fundamental analyst uncovers a piece of valuable information about a company, that information has already been widely disseminated and fully incorporated into the stock price by thousands of other market participants. Ultimately, both technical and fundamental analysis fail to deliver on their promises, leaving investors stranded in a sea of expensive, useless noise. The central revolutionary core of Burton Malkiel's philosophy is the concept of the random walk and the introduction of the efficient market hypothesis. A random walk is an economic term meaning that future steps or movements cannot be predicted based on past actions. When applied to the financial world, it means that short-term changes in stock prices are completely random and unpredictable. Malkiel compares the movement of a stock price to the steps of a deeply intoxicated person walking through a large open park. The next step could go left, right, forward, or backward, and knowing where the person took their last 5 steps gives you absolutely zero clues about where they will step next. This randomness is not a sign of a broken, chaotic market, ironically. It is the direct result of a highly efficient, hyper-competitive marketplace. The efficient market hypothesis states that the stock market is incredibly good at gathering information. Whenever a company releases an earnings report, a new product, or a strategic update, thousands of brilliant, highly motivated investors instantly analyze that data. Within seconds, they buy or sell the stock, forcing the price to reflect the new reality immediately. Because the current price already reflects all known information, the price can only move when a new piece of unexpected news arrives. And since news is, by its very definition, unpredictable, the day-to-day changes in stock prices must be random. Malkiel outlines 3 different forms of market efficiency, starting with the weak form, which states that past prices contain no useful information for predicting future prices, completely invalidating technical analysis. The semi-strong form goes further, asserting that all publicly available information is already fully reflected in stock prices, meaning that fundamental analysis cannot help you beat the market either. Finally, the strong form suggests that even private, insider information is rapidly incorporated into prices. While the market may not be perfectly efficient every single second, it is efficient enough that no individual or institution can consistently outperform the broader market averages over the long term without taking on excessive, dangerous amounts of risk. To prove this controversial point, Malkiel presents decades of performance data from professional mutual funds, hedge funds, and elite institutional managers. The results are devastating to the ego of Wall Street. Year after year, the vast majority of professional money managers fail to beat the performance of a simple, unmanaged market index like the Standard & Poor's 500. The few managers who do beat the market in a given year almost never repeat their success in the following years, proving that their outperformance was the result of pure luck rather than superior skill. Malkiel famously declared that a blindfolded monkey throwing darts at a financial newspaper could select a portfolio that would perform just as well as one carefully curated by professional financial experts. The market is simply too smart, too fast, and too efficient for any individual to consistently outsmart it. If the market is a random walk and professional advisors cannot beat the averages, how should an ordinary person manage their money? Burton Malkiel does not leave investors in a state of cynical despair. Instead, he provides a highly practical, empowering solution that completely revolutionized the global investment landscape. The adoption of low-cost index funds and the implementation of a disciplined lifecycle investment strategy. Malkiel argues that instead of trying to beat the market, your goal should be to match the market perfectly while keeping your investment costs as low as humanly possible. This philosophy led to the birth and widespread adoption of the index fund, an investment vehicle that simply buys and holds every single stock in a specific market index. An index fund does not hire expensive analysts, it does not try to time the market, and it does not trade stocks frequently. It simply accepts the market return. Because it eliminates the massive overhead costs and trading fees of traditional mutual funds, it passes those immense savings directly to the investor. Malkiel demonstrates that over a 20 or 30-year investment horizon, the compounding effect of lower fees gives index fund investors a massive, unstoppable advantage over those who use actively managed funds. By doing absolutely nothing and accepting market averages, you quietly outperform the smartest minds on Wall Street. However, successful investing requires more than just buying a single index fund. It requires a deep understanding of asset allocation adjusted for your specific stage in life. Malkiel explains that risk and reward are permanently linked together. If you want higher returns, you must be willing to endure greater volatility. He introduces a life cycle guide, which states that your capacity to take financial risks depends entirely on how many years of earning potential you have left ahead of you. A young professional in their 20s has decades to recover from a market crash, meaning their portfolio should be aggressively tilted toward equities and real estate index funds to maximize long-term compounding growth. As an investor ages and approaches retirement, their investment strategy must undergo a gradual, systematic shift. A person in their 60s cannot afford to see their life savings drop by 40% during a sudden economic recession, because they need that capital to cover daily living expenses immediately. Therefore, older investors must slowly reduce their exposure to volatile stocks and increase their allocation to stable, income-producing assets like government bonds and cash equivalents. Malkiel emphasizes that you must always maintain an emergency cash reserve and ensure your portfolio is globally diversified across different asset classes, countries, and industries to insulate yourself from a localized collapse. The ultimate secret to financial success on Wall Street is not intelligence, insider information, or complex algorithms. It is emotional discipline. You must learn to automate your investments through a process called dollar cost averaging, contributing a fixed amount of money to your index funds every single month, regardless of whether the market is booming or crashing. You must resist the intense psychological temptation to panic sell during panics or greedily buy into speculative bubbles. By accepting the reality of the random walk, embracing the efficiency of the market, and letting the miracle of compounding interest work undisturbed over decades, you transform investing from a stressful gamble into a predictable, triumphant march toward lifelong financial independence.